This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
You will no doubt remember that when we dealt with share disposals for individuals, we saw that there was more than one way of acquiring shares in the specific company involved. Obviously, you go out and purchase shares from existing shareholders, or as we'll now remind you of, you may acquire shares directly off the company itself. If that company were to make a bonus issue, or you were to take advantage of purchasing shares under a rights issue. So how do we deal with this? Now, there's going to be a slight difference here between what we did in personal tax for CGT for individuals and what we do now for corporate tax. What we do, of course, where either there is a bonus or a rights issue, is to record how many shares we have acquired under that issue and any cost that attaches to it. There is no cost, of course, when dealing with a bonus issue. There is a cost when dealing with the rights issue. Now, it's that point about with bonus issues that there are no costs that actually makes them easier to deal with so far as corporate tax and your share pool is concerned. A bonus issue increases, as we see here, the number of shares held, but with no corresponding increase in cost. So all we do is add in the extra number of shares that we have acquired. To do that, all you need to know is the terms of the bonus issue, which will be straightforward enough. And literally, all you do is to add in the extra shares. What we normally do when seeing shares acquired, though I have frequently used the word purchased there, is if you buy shares, you incur a cost, then what must you firstly do before adding in the shares acquired? It is, of course, re-indexing that index cost value on your share pool. Well, now, as there is no such extra cost incurred, all we literally do is add in the extra shares acquired. So we do not re-index the index cost figure on the shares that we have within the share pool there. There's no re-indexing to be done, as there is no new cost incurred, and obviously there's no cost to go in. So it is literally, for a bonus issue, a single entry item. State the date, what are the terms of the bonus issue, 1 for however many, 2 for however many, whatever it might be, and simply add in the extra number of shares acquired in the number of shares column, and there is no extra cost, there is no re-indexation, we said, there is no change in the index cost. All you've got to do is just readjust your total of shares now held. If it's a rights issue, then it's just like any other purchase that you might otherwise have dealt with, as we did within our previous session together. Just deal with it as a normal purchase. You've got a little bit more work to do in as much as you've got to work out how many shares have been acquired. It's a 1 for 4, a 1 for 3, a 1 for 5, whatever it is. You've got to work out those number of shares acquired and then apply the cost per share that attaches to that rights issue. And that becomes your cost, and it also goes into the index cost. Because, of course, there is cost, that means that prior to dealing with that acquisition, you must re-index the indexed cost column figure, your pool value on your index cost. Right, let's have a little look, therefore, at how we deal with this. Firstly, with example 3, where we've got calculate the gain on the disposal of the shares in October 2015. Remember, we would be asked to either compute this individually or it'd be part of a corporate tax computation for whatever accounting year ended, accounting period ended, of which October 15 would be included. What we're told is that Y Limited sold 2,000 shares in October 2015 for £12,000. We need, of course, to know with which shares do we recognise that disposal. So when did we acquire them? We acquired 3,000 shares in X Limited on the 20th of July 93. Very obviously not the same day as disposal and not in the previous 9 days. And the cost of those 3,000 shares acquired, £10,000. Then in February 95, X Limited made a 1 for 3 bonus issue. And that's it. That's all we've got to deal with. So in which case, therefore, it's a single calculation of a gain. We have sales proceeds of £12,000, and we do know, that all of those shares will have come from the share pool. So all we've got to do is put together now the calculation of that share pool. So how do we do that? Set up the share pool here for the shares in X Limited. We have our three columns: number of shares, cost of shares, and our indexed cost columns. The original acquisition was back in, where are we, 20th of July 93. 20th July 93. Acquisition. We purchased 3,000 shares, cost £10,000, and whatever goes in the cost column also, of course, goes in the index cost column as well. So in it goes 3,000 shares costing £10,000. The next operative event in terms of a transaction impacting upon the share pool is February 95. So when was that? It just says February 95, so February 95. Now then, normally, as we said at this particular point, what you would be doing is to re-index. But this is a bonus issue. There are no shares purchased. We simply get more shares. So this is the one and only time where we do not re-index. And literally all we do is to throw in the effects of that bonus issue. What were they? 1 share for every 3 shares held. So it's 3,000 shares in the share pool. 1 for 3 is another 1,000, which means we now own 4,000 shares, which are still deemed to have a cost, an index cost of £10,000. So we do not re-index on a bonus issue. Now, of course, what I've given you is what the examiner will also give you, which is an RPI for February 95. You don't need it, you won't use it. It is there simply to allow students, if they do not know the rule, to make that mistake and to re-index. If they had not included the February 95 RPI, then students would have simply have had to have done it the right way. So it's another rope by which to hang yourself there. Don't do that. So ignore any RPI, do not re-index on a bonus issue, just add in the extra shares acquired. So that means we can now go all the way through to the date of disposal, and we made the sale in October 15. So October 2015. This is a disposal, so what we must therefore do is to re-index. Now what you've got to remember is that original index cost figure dates back to July 93. Though we acquired more shares in February 95, we didn't pay for them. There was no purchase there of those shares, and hence there's no re-indexation that has occurred. So our re-indexation must go all the way back to the original acquisition cost in July 93, where we had the RPI of 140.7, and re-index all the way through to the date of disposal, October 2015. So for that purpose, therefore, our re-indexation. What is the RPI now? 259.5 minus what it was when we originally purchased those shares, 140.7, all over 140.7. Leave it in the calculator, of course, and multiply out by that already circled index cost figure of £10,000. So leave the RPIs in the calculator, apply to 10,000, and that, I hope, comes to a figure of 8,443. So the re-indexation, £8,443. So at this point of disposal, the index cost value on the share pool at that date in October 15 has now gone up to 18,443. So there's still 4,000 shares, the cost is £10,000, and the index cost 18,443. Now that we've re-indexed, now you can deal with the disposal of this date. So how many shares were being sold at this point in time? We're told there, let's just go back and see, Y Limited sold 2,000 shares in October 15. So disposal, oops, not been too far, there we go, disposal, 2,000 shares. So we're selling 2,000 out of 4,000. It will leave 2,000 shares in that pool there. And with those 2,000 shares, we take the relevant fraction of course, both the cost of 10,000 and the index cost of 18,443. So our calculation, therefore, will be we sell 2,000 out of 4,000 shares where there was a cost of £10,000. We're obviously selling half of the shares here, so half of 10,000 will be £5,000. Apply the same 2,000 over 4,000 on 18,443 worth of index cost. So we've got to split this, just rounding, a bit of rounding here, one way or the other. And let's say we take half of the 18,443, well, we'll just go with 9,221. If you put 222, it makes no difference at all. That's absolutely fine. You can, of course, then update. The 2,000 shares that remain still have a cost there of 5,000. And, well, as we took out 9,221, that'll leave 9,222 within our index cost column for purposes of dealing with another disposal. Now all we've got to do is to show our gains calculation. Now that again you should now be able to do without any more addition from me. But have a look at what we're told in the question. We are told that the shares, let's go back, were sold for £12,000. So sales proceeds £12,000 less. What is our cost figure? £5,000. What is our indexation allowance then to further deduct? Well, that's the difference between index cost of 9,221 and the cost column of 5,000. Again, don't even need a calculator for that. That's going to be £4,221 worth of indexation allowance. Take that from your unindexed gain and you get your chargeable gain. You'll find there will still be a gain here, your cost and indexation, which totaled 9,221, as we've seen, are less than the sales proceeds of 12,000. So we'll end up with a gain. That gain should be, methinks, £2,779. Now, just have a little check of that answer and the methodology with the answer in the back, if you would be so kind, before then returning to this, and we will continue with, and hopefully complete within this session, the remaining parts of Chapter 19. Okay, well, hopefully you are also okay with indeed those calculations in relation to the gain arising on the disposal of those shares and how it is that we deal with a bonus issue into the context of the share pool for a company. Just to make the point that if back in February 95 the issue we were dealing with was instead a rights issue, then what difference would that have? Now, we'd still have had, of course, the July 93 original acquisition. If now it was a rights issue, then at this point, prior to putting in that rights issue, in there, you would be re-indexing your £10,000. And it would be re-indexed to February 95 from July 93, which means you would therefore have been using the RPI for February 95. The re-indexation would have read 10,000 multiplied by the RPI then, February 95, 146.9, minus July 93, 140.7, all over July 93, 140.7. And that figure would then have gone in to your index cost column there. The issue would have been a rights issue, so you'd be told on a rights issue that it was 1 for 3 at whatever price per share. For the sake of argument, let's call it £4 per share. So 1 for 3, that was another 1,000 shares, and now you'd have had a cost of 4,000. Any cost coming in impacts on both the cost column and the index cost column. In it would go, and you'd revise your totals there for both cost and index cost. The cost would obviously be 14,000, and your index cost column would be the 14,000 plus whatever the indexation was, the re-indexation from July 93 to February 95 on the original £10,000 figure in that pool. Likewise then for October 15, you'd re-index now that revised index cost all the way through to October 15, but this time of course not as it was here from July 93, but instead from February 95, because you would now have re-indexed in February 95. So you just deal with it like any other purchase. There is no difference there. It's the same as dealing with any other purchase. Okay, we move therefore now from dealing with outright purchases, bonus issues, rights issues, to probably the more interesting of the circumstances we ever have to contend with, which is of course takeovers. Now then, remind ourselves of what is happening. What will have happened is that we originally bought shares in a particular company. Maybe we bought shares in A plc. But then at some point along came another company, say V plc, and took over A plc. That means that we got issued with, as no doubt this will be a share deal, we've got issued with shares in V for the shares that we held in company A plc. Now that's known as a share for share deal, a paper for paper deal, and if that is the case, then if you are only receiving bits of paper, no gain will actually arise in relation to that takeover. But of course the problem that you now face is, instead of owning shares in A plc, you now own shares in V plc. And it is subsequently the object of this exam question that you sell some or all of those shares in V. Problem, as ever, cost. You didn't buy shares in V, you bought shares in A. So what do we need to remember? That when there is a takeover, the new shares take on the cost of the old shares. So let's just remind ourselves of those basics. Where a takeover is a share for share deal, otherwise known as paper for paper, the shareholders of the company taken over acquire shares in the acquiring company. So I was a shareholder in A plc, I now become a shareholder in V plc. If, for example, I had owned 10,000 shares in A plc, and now V plc says, for every A share that you own, we will issue you with 2 shares in V. In which case, instead of now owning 10,000 shares in A plc, I own 20,000 shares, 2 for 1. I own 20,000 shares in V. But they will still be deemed to have the same cost and index cost now of the original A plc shares. So where there is a share for share deal, this normally does not constitute a chargeable disposal. Again, you may recall back when we covered this area in personal tax for individuals in CGT, there is an election to disapply the share for share relief. It is not likely that that is going to happen in relation to corporate tax. It's very much more possible when dealing with CGT for individuals. So, the new shares, therefore, deemed to have been acquired for the same cost as the original shares. Same cost, and indeed the same index cost. A takeover may involve attributing, again this third point, attributing the cost of the original holding to the different component parts of the new holding. Yeah, if it was a very simple takeover, such that I had a share pool for A plc that said I had 10,000 shares that had a cost of £50,000 and an index cost at that date of 60,000. So number of shares, cost of shares, and index cost. So I would have my routine share pool up to the date of the takeover. And in A plc, as we said, I own 10,000 shares with a cost of 50,000 with an index cost of 60. So if this takeover is the simple one that I referred to, V plc issued shareholders in A with 2 shares in V for every individual share held in A. what would now happen to the shareholders' share pool? Well, now, instead of being under the heading of the share pool for A plc, A becomes V. And instead of 10,000 shares here being held within A, it was 2 for 1. 2 for 1 on 10,000 means you've now got 20,000. But they are still deemed to have cost 50,000 and at this date have an index cost of £60,000. So that is the simple share for share deal. But of course what might happen, as we've now said, is that we may have a takeover that involves a mix of consideration. Now, to begin with, the first type of mix that we'll see is just different bits of paper. Now, the classic mix there, a mix of consideration, a combination of ordinary and preference shares. They will have different values, and what have I got to do? I've got to allocate the cost, and if necessary, I'll come back to that statement in a short while, the index cost figures on the share pool for what was A plc shares. I've got to allocate those now to two things: the ordinary shares I acquire in V, which will be in one share pool, and the preference shares I have in V that will be in a different share pool. How do I do that? This is done by allocating the cost of the original holding, 50, and as I said, if applicable, the index cost, allocating the cost of the original holding to the new shares according to the market value of what is received at the time of takeover. And for this, as I say, we'll see example 4. So what that means is list out the market values of what you have received. How many ordinary shares, what are they worth? How many preference shares, what are they worth? And you then use that as a basis for splitting out your cost figure in your what was still then an A plc share pool, and if provided, the index cost. Now this is one of the areas where the examiner again has in past questions made life easy for us in a way that we'll see in a moment, that means that they don't actually give you an index cost figure at the time of takeover, they just give you the cost. And it's that figure that then we divide according to the market values of what we receive. And what we do, though technically not quite right, it's a shortcut that the examiner allows us to use, and in fact a shortcut that, given the information provided, is the only technique we can use when this information is provided this way by the examiner. But we only get the cost figure to divide between the preference shares and the ordinary shares. When then in the future any of those shares are sold, we'll do a separate indexation calculation. Now let's illustrate this issue with example 4. We'll show you how to do it in relation to the information provided, as is likely to be the case in your exam, and then briefly explain what should have been done in real life to be able to deal with that. Again, all the examiner is doing is to provide you, as we spoke of in the previous session, to provide you with an indexation factor to allow an indexation calculation to be done rather more easily. Is cutting down on the amount of work that you have to do. Now, if the examiners want to employ shortcuts that make life easier for us, we will have no, again, problem with that behaviour by the examiner. Clearly, if they want to make it easier for us to get the right answer, we're all for it. I'll explain how technically it's not quite right, but again, just show the basic calculations we need to perform. Right, let's make some sense, therefore, of these rules. Example 4. Calculate the gain arising as a result of the takeover in July 15 and then the sale of the BPLC preference shares in October 2015. Right, what happened? Company we're dealing with and for whom the gains need to be computed, Z Limited, acquired 10,000 A Limited shares in July 89 for £10,000. So we're dealing with Z Limited it had originally acquired shares in A Limited. But what we have just read is that there's a takeover in July 15, and it would appear clear that arising out of that takeover, a part at least of what we have received is preference shares in B plc. Let's get the full story of that and deal with it therefore. Right, Z had acquired 10,000 A Limited shares in July 89 for £10,000. In July 15, B plc takes over A Limited. Let's just get rid of that so we can then read it. In July 15, B plc takes over A Limited, and for each A share in A Limited, Z Limited receives, this is receiving of course from B plc, 2 B plc ordinary shares that have a price of £1.50 each, and 1 BLC preference share that has a price of £1 each. Now if you're seeing similarities here to what we saw in our personal tax, our CGT section, it is true we're dealing with the same basic issue here. Right, the preference shares are then sold in October 15 for 15,000. That's this part of the question here that we've got to resolve. And the indexed rise from July 89 to October 15, July 89 to October 15, is 1.247. Right. What this means is that at the date of takeover, which was back in, where was the takeover? In July 15, they have not given us the amount of indexation that would have applied to your holding of A Limited shares. So the working that we do is going to be based purely, as it was in CGT for individuals, on a division of the cost. But let's just look at the notes and what it is that we now need to do. When we've got a takeover involving attributing the cost of the original holding to different components of a new holding, we originally had 10,000 A Limited shares, and we're now receiving a combination of ordinary shares in B and preference shares. What do we do? Simple. We list out the open market values of what it is we have now received. That is ordinary shares, and in a moment preference shares. Right. How many shares did we originally own in A Limited? 10,000. What are the terms of the deal? For each of those 10,000 shares, we get, there it is, 2 BPLC ordinary shares times 2. And how much is each BPLC share worth? £1.50 times £1.50. So we had 10,000 A Limited shares, and VPLC gives us 2 of their shares for every individual A Limited share held. 10,000 times 2, we've now got 20,000 shares in ordinary shares, that is, in VPLC, which at the time of takeover were then valued at £1.50. So 20,000 at £1.50 will be £30,000. Employ exactly the same technique in relation to the preference shares. We had owned 10,000 shares in A Limited, and what do they give us in the way of preference shares? Ever so easy, 1 such preference share for each A Limited share held, and they're valued at £1 each. So 1 share at £1, just to differentiate the ones, put a pound sign in there, at £1. That therefore very clearly is a market value of 10,000. So we have received £40,000 worth of shares in here, the new company BPLC, made up of £30,000 worth of ordinary shares and £10,000 worth of preference shares. Use those market values now listed to divide out what was the figure we provided with in relation to the original A Limited shares. That was a cost of 10,000 that goes all the way back to the original acquisition date in July 89, where we bought them for £10,000. we now use these market values as a basis for splitting out that cost. So, using these market values, 30,000 out of 40,000 times 10,000, 30/40ths of that cost, i.e. 3/4, £7,500 of the original A limited share cost of 10 belongs to now our ordinary shares held in BPLC. Then 10,000 over the self-same 40,000 times still 10, the other 1/4 of the 10,000 cost, i.e. £2,500, is attributed to the preference shares. Now, if we were doing this technically correctly and the information provided allowed us to do it, then at this date of takeover in July 2015, we would also have been provided with information about index cost. Now, they could simply have told you, now I've got to make numbers up here because they haven't given us a figure of index cost. But maybe they told us at that point in time, in July 15, that the index cost to that date was, say, £20,000 or whatever. All you would then do is to do the same division of the index cost total in the way you've divided the total, the original cost total. So 3/4, 30/40ths of that 20,000 would now be attributed to the ordinary shares, so that would be 15,000, and 10,000 over 40, 1/4 of the 20,000, i.e. 5,000, would be attributed to the preference shares. That means at July 15 you could now set up two separate share pools, both of them being shares in BPLC, but one ordinary, the other preference. And what would they now say? Look at your ordinary shares. You now own how many ordinary shares in BPLC? 10,000 times 2 was 20,000 shares. So at July 15, you'd set up a share pool for ordinary shares in B that would read number of shares, that would be 10,000 times 2, 20,000. And then from the above working, pick up what your cost and index cost figures were. The cost, 7,500, the index cost, 15,000. You would then set up a separate share pool for preference shares where you would have 10,000 shares, and this time those 10,000 shares would have a cost of 2.5 and an index cost of £5,000. And you'd have two separate individual share pools as at July 15 with the number of shares, cost of shares and index cost. Should then there be a sale out of any of those shares, you'd be able to re-index from July 15 through to the then date of disposal, your index cost total, and having done that, then deal with the disposal in the normal way. How many of the shares have been sold, take out the relevant proportion of cost and with it index cost, and that allows you to calculate the gain. But here, what has happened is they haven't told you the index cost. They haven't told you RPIs or indexation from July 89 through to the takeover date, July 15. Instead, and I repeat, this is to make life easier for you, they tell us that the indexed rise from July 89 through to October 15. What happened in October 15? The preference shares were sold for £15,000, and they tell us there's an indexation factor. Now, the reason why they're doing this, as I say, is to make life easier for us. So what now will be the basis of our gains calculation? All right. How much do we sell the preference shares for? Now, you're going to have to forgive me if I try to squeeze this in here. I hope this presentation doesn't cause you any trouble, but it's just so you can see it all on one page. If now the preference shares, here we go, there it is, sold in October 15 for 15,000. Sales proceeds £15,000. Less cost. What cost are we going to use in relation to those preference shares? That's where this particular column, the only column indeed that we could run, oops, I should have stopped it there rather, the only column that we can run here, what now will there be in there? We know that of the original cost of £10,000 on your A Limited shares, we allocated £2,500 to the preference shares. It is they that are now being sold. All of them are being sold, so they are deemed to have a cost of £2,500. Take it away, and that would give you an unindexed gain there of 15 less 2.5, what's that, £12,500. And then from it, you would need to deduct indexation. Now this is the bit that they're trying to make easier for you. They've told us, this bit here, let me clear the decks for that we have an index rise from July 89, when you originally acquired your A Limited shares, through to October 15, where we now see a disposal of the preference shares at 1.247. What do we do with an indexation factor? There, 247. We apply that to our allowable cost. There is the allowable cost. So literally all you've had to do is this part of the calculation there that divided out that cost of 10,000 according to those market values. So 1.247 times 2,500, that would be the indexation to come away and would then give you your chargeable gain. So what I'd like you to do, please, is just do that calculation for me. Once done, you've got your chargeable gain, and then we'll look at the answer to this example together before moving on to the final part of dealing with these takeovers. So if you just work that for me, and then we'll review the answer together. So looking here at the answer to example 4, let's just ensure that we've understood what was being done, where the technique shown is the technique as has been used by the F6 examining team there, which is to simplify the scenario of the takeover. So what have we got here? It says, as the terms of the takeover are indeed a share for share transfer, no gain will therefore arise at the time of the takeover. It's paper for paper, share for share. There is no cash, no gain crystallizes, there'll be no taxability at that point. So how do we deal with that takeover? The new shares, those that we've acquired in B plc, will take on the same original cost as the old shares in A Limited. Now, as we have already spoken of, had there been an index cost provided, you would divide that index cost in exactly the same way. So, with the new shares in B plc taking on the same original cost as the old shares in A Limited, and would also take on at the time of takeover the index cost. But as we've said, there are two types of share being issued. Therefore, we use the market values of those shares as the basis for dividing the A Limited share cost. What was that A Limited share cost? £10,000. What were the open market values of what you've now received? The ordinaries and the preference shares in B. Their market values are 30 and 10,000 respectively. Use those market values to divide that cost. That gives you 7,500 to the ordinary shares, and critically, because it's the preference shares that we go on to sell, a base cost of £2,500. Into your gains calculation for the subsequent disposal of the prefs in October 15. What were they sold for? 15,000. What is the cost? 2,500 from that working there, and then we simply index that, given the index rise provided from the original purchase date of your A Limited shares all the way through now to the disposal of these preference shares. That gives you your indexation allowance, take it away, and you've got your chargeable gain. Not that it was asked for here, but as we have identified there, the cost of the ordinary shares in BPLC that would be used in terms of any future disposal of them would be $7,500. Again, what would have to happen, given the information provided here, if you're going on to deal with that disposal, the examiner would have to tell you an indexation factor that would have run from the original acquisition date of the A Limited shares all the way through to the disposal of those preference, the equivalent to the 1.247 there. Now, as I say, in reality, what you would have to do at the time of takeover is, based on the date you acquired your A Limited shares, based on the date of the takeover, you would be able to take the share cost of £10,000 and calculate for it an index cost figure. Normal reindexation. You would then split that total index cost figure between the ordinaries and the preferences, again by reference to those market values. And that would tell you at the date of takeover at July 15 both what the cost of the shares was for the preference 2.5 and what the index cost was. All you would then have to do on a subsequent disposal of those preference shares in October 15 is to re-index that index cost figure there from July 15, the date of takeover, through to the date of disposal, October 15. It would have been extra calculations of indexation that would have been required to do it technically correctly. Again, the examiner has basically removed that from the calculations required by you by telling you here is an indexation factor that shows an indexed rise from the original acquisition of the original shares through to the date of this particular disposal. That then allows you to simplify the gains calculation to that which you see there. Technically, it isn't quite right, but let's not knock it. The examiner is trying to make life easier for you. We will not have an objection to that. Right, have a look at that answer. Make sure, please, that you're happy with it. Before then, we'll move on to deal with the final part of this problem. Okay, final part, therefore, of dealing with this problem of takeovers is, whereas in the previous example, all that we received at the time of takeover was bits of paper. It happened to be two types of share, ordinary and preference, that demanded, therefore, that we divide out cost and, if provided, index cost at that date, divide it out according to the market values of what we have received, the preference and the ordinary shares there. Divide out the original share cost and index cost according to those figures. But because it was entirely paper for paper, share for share transfer, no gain actually crystallized at the time of the takeover. But normally, of course, in terms of takeovers, the takeover company is going to have to pay out some cash. So the usual mix of consideration at the time of takeover is some type of share. In the example we're about to do, example 5, it will be ordinary shares, and also some cash. This therefore means that as you now receive cash at the time of the takeover, that therefore if you have received cash, a gain will crystallize and that gain must now be computed. So this time, at the time of takeover, there is indeed a gain that arises that needs to be computed and taxed by reference to that date. So, using example 4, we're told here, what difference would it make if Z Limited receives at takeover? Now, what did we have? We're still getting 2 BPLC ordinary shares that are still valued at £1.50 each. But instead of one preference share in BPLC that is worth £1, we got one preference share valued at £1. Instead, we get £1 cash for each share that we had originally had in A Limited. So all that's happening is that the mix of consideration received is the same value of ordinary shares as in example 4, but instead of preference shares worth 10,000, we get £10,000 worth of cash. And because cash is received, that means that there's going to have to be a gain calculated at this point in time. So how do we deal with it? The same working as we saw before. In relation to the terms of the takeover, list out the open market value of what it is you have received and use that market value to split out the original cost of your A Limited shares. And if it were provided, it is not, you'd also use those same values to divide index cost, were it to have been provided. It wasn't. So what did we receive? We received firstly ordinary shares in BPLC. How many? Well, we'd had originally 10,000 shares in A Limited. We now get 2 for 1, so we've got 20,000 ordinary shares received in B, and they are valued at £1.50 each. So exactly as we had it before, the market value is £30,000. We then get cash. What that is, for each of the 10,000 shares held in A, we get, if I show the full calculation, £1 of cash. So 10,000 at £1 of cash is a value of 10,000 and a total of 40. So it's exactly the same exercise as we did when it was ordinary shares and preference shares. All that happens though is cash is substituted in for preference shares. What must we still do? Divide out the original share cost of the A Limited shares, i.e. 10,000, according to those market values. That is still the same 3/4, 1/4 split. Based on 10,000 is 7,500 and 2,500 respectively. Had we had an index cost given, that figure would also have been divided 3/4 and 1/4 between the ordinary shares received and the cash received. As it is, they didn't provide us with that. We didn't have the RPIs for when we bought and the date of takeover. So what they do give us, as seen in the previous example, is an actual indexed rise, expressed as an indexation factor, between July 89, when you originally acquired your A Limited shares, and now July 15, which of course is when the takeover took place and you received this cash here. That's when you received that cash. And that, as we can see there, is, what's that? 1.239. So we need to show, therefore, our gains calculation. Now then, how much cash did we receive? We received 10,000. That is your sale proceeds. What do we now know to be the deemed cost attached to those proceeds? £2,500. What do we then need to do, having deducted cost of 2.5 from proceeds, cash received of 10? We'd have an unindexed gain of £7,500, from which we deduct indexation allowance. There is your indexation factor, 1.239. What is the cost figure in this gains calculation? £2,500. Multiply out the 2.5 by the factor of 1.239. You have your indexation allowance, deduct it and derive the chargeable gain that arose, therefore, at the time of takeover. So the only difference to what we saw in example 4 is we're now receiving cash instead of preference shares. Because you get cash, immediate gain crystallizes. Split out the original cost of the original shares, same basis as before, as we see there, based on the market values of what you've received. And once you've got that cost figure, you can then put it into your gains calculation. There's your proceeds, there's your cost, index that cost, and you've got yourself your chargeable gain, and the job is done. Now again, to make sure you're happy with that, please refer through to the answers at the back of these course notes. I think that is page 196, the bottom of, and check out the answer to example 5. And that therefore brings to an end this particular chapter dealing with the basics of gains for companies under corporate tax and dealing very specifically with transactions in shares. When we sell shares, we'll always know what we have sold them for. The problem is when those shares are sold, what is their cost? That demanded that we learn the share identification rules and then how to apply those rules. It isn't likely that we will have sold shares that were acquired on the same day. It is more likely that we may have sold shares that had been acquired within the previous 9 days. It is almost certain that we will be disposing of shares that would have gone into the share pool. So most of our time and work and effort goes into putting together that share pool. Based on when did we originally acquire shares, adding in any further acquisitions, remembering that if you bought shares, you paid for shares, normal purchase or rights issue, you firstly re-index your index cost column and then add in the number of shares and cost of shares purchased. If dealing with a bonus issue, just add in the number of shares. No re-indexation, no further cost to add in, it's just extra shares. The most difficult type of problem is dealing with takeovers. If it is just a share-for-share deal, then divide out your original share cost on your original shareholding according to the market values of what you have received. If you were given an index cost or the ability to compute an index cost at the time of the takeover, then you would use exactly the same values to split out the index cost. The most likely outcome for you in an exam is that you won't have that index cost figure, nor the ability to compute it, because the examiner will be trying to help you by giving you a shortcut exercise to do in relation to a future indexation calculation. But the cost figure will have to be divided between the two types of shares, in example 4, as we've just seen, ordinary shares and preference shares. Should then any of those shares be sold in the future, you know what you've sold them for, you now know the allowable cost of those shares, and you can apply to that allowable cost the given indexation factor index rise. Whether that indexation factor, as we've done here, has been rounded to 3 decimal places or given just a pure indexation factor on however many decimal places, so without rounding, you just use what they've provided for you, and that allows you to work out the gain. If at the time of takeover cash was involved, we received cash, then at the time of takeover, as just seen in example 5, in relation to the amount of cash received, there is an immediate gain to compute. Same working, split the original share cost of what in this example was A limited between the things you have received, here ordinary shares and cash, according to the market values of what you have received. That tells you the cost figure relevant to the cash received. That's your proceeds figure, that's your cost figure. Apply the given indexation factor, index rise, to your cost figure and work out the gain accordingly. Thank you very much. Job done. As it says there on your screen, you may now attempt practice question 25 at, again, the back of the course notes. Before then, we will continue on with our next chapter, chapter 20, again continuing with the particular issues that are more likely to arise in terms of capital gains for companies within corporate tax. I look forward to seeing you then.